G'day expats, welcome to another episode of Expat Chat, episode 89 today. I'm Mitchell Kelsey, one of the financial advisors here at Atlas Wealth, looking after clients in the Asia Pacific region, and I'm joined by my colleague, James Ridley. How are you, mate?
Good, thanks, Mitchell. Thanks for the introduction. And ladies and gentlemen, those who are tuning in today and viewing us on YouTube as well, Brett's still away. He's still on leave and we've kicked him out and he's still somewhere in Europe. So he's enjoying his time off with his family. So we're recording a few episodes while he's away. Hope you've been enjoying it. Maybe we're replacing him. Hopefully, Mitchell, hopefully. Um, Today, we've got some interesting topics to run over, a few different ones. I think in the past, we've always sort of tried to focus around a main theme, but today, I guess the theme is client conversations. And we're going to cover a few different topics, and they have been driven by client conversations just in the last week. And I guess it'll give our listeners a bit of an insight into the broad, I suppose, topics and issues that expats constantly face, which I think everyone will bring home quite well and quite true for a lot of our listeners. So we'll get into it shortly. I better just rattle off a quick disclaimer. So anything you hear today or see today is for information and entertainment purposes only. It is not to be construed as personal advice. If you do need personal financial advice, please feel free to reach out, but it should only be consumed for entertainment purposes only. All right, mate, let's jump into it in terms of our first topic. Throwing it over to you. What have we heard this week?
Yeah, James. So, more recently, it just so happens I've been speaking to clients that, they're coming back to Australia and, they've still got their overseas properties. So they've got their properties that were previously their main residence, wherever they were residing before they decided to come back to Australia.
Yep.
And for whatever reason, it just made sense not to sell the property, keep it there for the time being. But they're wondering if I do sell it in the next couple of years, what are the tax, the CGT, capital gains tax implications here in Australia as a resident for tax purposes again. And a couple of nuances to that. We talk a lot about the main residence exemption in the context of, I guess, Australians who previously resided here in Australia in a property, and then they move overseas, they retain this property, and we sort of advocate and sort of promote the fact that, you're not afforded this main residence exemption as a resident for tax purposes. But this main residence exemption, it works in a number of different ways, and it can also be applied to, a property that was overseas as well. So did you want to sort of add anything else to that?
Yeah, I mean, you said it really well then. And I guess it does mean that when clients decide or expats decide to come back to Australia, it's easy to just give an example, the client's coming back from, say, the United States and they've got their US main residence. They're coming back, they're going to rent in Australia for 6 to 12 months. They're not going to move into maybe a property that they own in Australia, but just rent for a period. They can choose to then sell that former US main residence and that'll be covered under the main residence exemption. So it's a tax-free transaction, which is really, really good. You want absolute certainty that you're not going to be paying a huge amount in tax. And I think with the US, I think generally if we've owned the asset for a while and the capital gain is under 250,000 or 500,000 if you're filing as a joint couple or married household, that those capital gains are exempt. So that's a really good way that you can apply the main residence exemption when you're coming inbound from obviously a different country. The caveat is that you're not moving into an old property and establishing a new main residence. It gets a bit murky, the waters are a bit grey when you sort of buy a property back in Australia, you move into it, but then you're still trying to sell the old, say, US main residence and how that might be treated. The ATO sort of gives a bit of an overlap there and says, generally we'll allow a 6 months sort of freedom period there as you transition into your new main residence. If you're going to rent out that other property though, that's when it's like, okay, well, maybe there's a bit of cost-based resetting, the market valuation rule might apply and there's a bit more work for the account to do. But people and expats, they often forget that, main residence exemption can be applied technically on the inbound side when you're coming back to Australia. So it's a really important talking point.
Yeah, definitely. And like you said, where clients maybe already had a property in Australia, they just moved back into that. And as we know, with the main residence exemption, you can't treat two properties as your main residence concurrently for the same period.
Hmm.
So if you're going to, establish a previous main residence here in Australia, you've got your previous US, for example, or international property, and you look to sell that 6 months later,
Hmm.
there's a deemed acquisition, I guess, event that occurs. So the day that you arrived back in Australia, if you're looking to sell that, 6, 12, 18 months later, and for whatever reason, you don't want to apply the main residence exemption because you're treating your new home here in Australia as your main residence for that period. Important to note that, you're not going to be subject to capital gains tax with the Australian Taxation Office for the entire sort of ownership period since you purchased that overseas property.
Yeah, that's right. It's a really interesting sort of conversation we've had with a few clients. I've had one recently where the client honestly isn't probably a proper expat. And what I mean by that, it isn't actually a non-resident of Australia for tax purposes. And the reason for that is they've only been over for a very short period. They've only been overseas for a very short period, not even 12 months. And they're in a situation where their job and their role is in a state of flux. And they actually might come back to Australia as early as next year. And because that's such a short period, it's really hard for them to have gone through the process of really formally, permanently cutting ties with Australia. So right now we're sort of going through the process of, well, because it's such a short period, you might be coming back. It might be a case where you still will be treated as an ordinary Australian tax resident. They're in the UK, so tax rates are similar. Australia's probably a little bit more punitive, so it would mean that they'd have to pay tax on their UK sourced income or wage income, but it means that they're still entitled to just all the normal things from an Australian tax resident aspect. And what we mean by that is, your normal capital gains tax concessions, your standard income tax rates, all those sort of things. So that's sort of what we're going through right now, whether sometimes is it better off to keep yourself as a resident versus a non-resident. And in this scenario, as an example, it's because they've been only overseas for nearly 12 months. It's going to be a case where most people would deem them to be still a resident because they really haven't cut ties for long enough. And given all their sort of, I suppose, other information about the scenario, it hasn't been enough formally cut from Australia. I don't know, Mitch, have you come across that where people they've intended to go overseas for a long period, but it's been cut short, so their residency kind of gets caught back into question?
Yeah, definitely. It comes up a fair bit, and ultimately it's not the end of the world. Like I think a lot of Australians, a lot of Australian expats, they're sort of adamant that they want to be a non-resident for tax purposes as soon as possible. But in some situations, it's not. Like I said, it's not the end of the world if you need to retain that residency status for an additional 12 months. And I mean, ultimately, like at the end of the day, it's like tax residency is a question of fact. It's you need to have your living situation needs to support your tax residency status. So you can't necessarily say you're not the one that decides whether or not you're a resident or non-resident per se. But yeah, just even if if you do need to retain that Australian tax residency status, it's not the be all or end all in terms of impacting your finances.
That's right. And I mean, a quick shout out to Ben Turner, our managing director for the tax side at the Atlas Wealth Group. He did a really good article on the recent final guidance around the ATO's decision to update the residency. I'm not going to say residency legislation because it actually hasn't changed. It's more so updated guidance to apply in today's world, more of a modern world. And they actually give quite a lot of examples, which is really, really good. So some cases you can almost apply some of those examples to your own situations and see where you fall in. If you've been overseas and a non-resident for a long time, I don't think you'd have anything to really worry about, but it's more so those types of expats or categories where they're traveling back and forth between Australia a lot, and you're really running a fine line there. So yeah, that's a good one. That's a really good one. I wanted to throw out today a client conversation I had earlier in the week, and it was actually about the importance of having a will or an estate plan in place, plus not just you or the client, but also potentially their parents. And what's happened in this situation, and Mitchell doesn't even know this, so is the client doesn't have any siblings. They're overseas. They've been overseas for a number of years now, and they've got one surviving parent who is very sick. And the remaining parent doesn't actually have a will in place. And we're talking about if something was to happen to that parent as they get older and they're getting a little bit sick, the expat's going to have to come back and obviously take care of the estate, the assets. But right now, there's nothing that's really governing the estate. There's no framework. There's no formal document that says this is what should happen to these assets and how they should be sold and whether they're put into, say, a testamentary trust or given away a letter of wishes. So we're sort of working through the importance of, one, having a will in place, and two, bit of due consideration given that she's an expat, a non-resident, and what that means for certain assets that they might inherit. And probably the most common one we come across is, Mitch, that CGT K3.
Yeah, it is, and that can be I guess, a bit of a nasty one for. I guess it may not necessarily be a nasty one for
No.
the Australian expat that might be inheriting, shares, for example, but it might impact on the other beneficiaries of an estate. So just as a bit of a refresher in terms of CGT event K3, it's basically a capital gains tax event that is applied when certain assets pass to a non-resident beneficiary, a non-resident for tax purposes beneficiary. So these are the types of, I guess, I don't want to say problems, but items that will come up when, someone is speaking to an estate planner and they're looking to understand who are the beneficiaries of this individual's estate.
Yep.
And then, making the relevant, adjustments to or provisions to ensure that the best possible outcome, is the best possible outcome is yielded for those beneficiaries.
That's right. And like the quickest example I've given to clients in the past about a CGT K3 event happening is if I'm a non-resident and I have a brother, his name's Andrew, and he's in Australia, he's an Australian tax resident. Let's say Andrew's going to inherit $300,000 in cash and I'm going to inherit $300,000 in shares. Well, that actually creates a very uneven playing field because CGT event K3 will force those shares to be sold in the estate and tax will be paid on those shares before they're given to me. So I'll be given, say, a reduced amount from an inheritance aspect compared to Andrew that's just receiving cash, which there is no CGT or inheritance tax on or gift tax. So that's how it can create some inequalities in the estate, and it's not really often talked about. So, and it's a hard conversation to have when there's a will being drafted up for the family. But I guess going back to the whole purpose of a will, and the way I like to communicate it as it's making hard decisions now, so your loved ones in the future don't have to make those hard decisions. It's providing a framework for your family, so all the hard decisions have been made by yourself whilst you've had the capacity to make them. So you're really just removing, those tough decisions, those emotional decisions as to when it even might be time to pull you off life support. And that's what we call an advanced health directive, and having the relevant POAs in place and those sort of things. So if you don't have a will and you're getting on, it might be time to look at and have a chat to a solicitor to make sure that framework's in place. So you're ensuring your family doesn't have to make those decisions in a very hard and emotional time and take an emotional toll on them as well. So that's my piece anyway. I've harped on enough there about that today. Throwing it over to you, Mitch. What else has been on the cards the last week? There's been some big things in the news. I know that.
Yeah, so I guess shifting gears a little bit. Inflation. Inflation has been one of the biggest drivers for share market movements over the past 12, 18 months. And in terms of combating this inflation, we've got central banks of the world lifting interest rates to try and I guess reduce price pressures on goods and services all around the world. And more recently, the Australian Reserve Bank, the Reserve Bank of Australia, it got a bit of a grilling in earlier this year. There was an independent review into the Reserve Bank, the government wanted to understand I guess the decision-making processes in terms of when interest rates are lifted, left on pause, and see if they could improve that process and improve, I guess, the transparency and the communication that's coming out of the Reserve Bank. And so that all happened in March, and then as part of that review, there was a series of recommendations that came out. Some of them really they were sort of scathing of the Reserve Bank, and I
Yeah.
guess sort of undermined a couple of the members of the Reserve Bank as well. And earlier this week, we had the RBA governor, Phil Lowe. He was sort of making a speech here in Brisbane, and he had, I guess, the opportunity to respond to the review. And essentially, like, in addition to how he's talking about other things, of course, monetary policy, but some of the, I guess, the biggest things to come out of that speech was they're really looking at, or that they'd like to employ some of the, or accept some of the recommendations that came out of that review. And some of the big ones were reducing the number of times that the Reserve Bank of Australia meets in a given year and makes an interest rate decision. So as we know right now, they meet every month. They meet on the first Tuesday of each month, with the exception of January.
Yep.
And it was proposed that they meet not 11 times, but maybe bringing that back to 8 times, which is quite interesting, and sort of makes it similar to, I guess, the interest rate schedules of other central banks. For example, the Federal Reserve in the US, they meet a lot less regularly than once a month.
They do.
And so that was quite interesting. And then in addition to that, it was proposed that they would also speak like the board members would sort of hold a press conference and respond to media after the interest rate decision has been made. So me personally, I think it's good. It's, sometimes we don't necessarily need an interest rate decision, every 4 weeks. So I think, it makes sense. And then, giving I guess the members an opportunity to sort of, rationalize and explain the decision right after the interest rate decision is good too. We know we get that statement after each interest rate decision, but just hearing it from the members would be great, I think, in my view. What did you think of that?
Yeah, I mean, it could, it's good. One, it would mean, like, if that sort of practice was in place the last 12 or 18 months, the interest rate increases we would have seen would have been bigger, because they've got less obviously intervals there. So rather than 0.25s, more 0.5s. I like the idea of having the whole board front up for media. So being interviewed by the media, because right now we all forget that Governor Lowe, he's obviously the chair, but he's the face of the RBA. He is not the sole person that makes the decision. He actually can't make the decision on his own. It's put to a vote. If he wants to overturn the board, he has to go to the Attorney General. So we all forget that. We're all, the blame game sort of been put straight onto Governor Lowe, and that's why he's probably out of a contract come September, although he said, I'll hang around for another year if you need me. But I think with that in mind, it also, I want to say shares the blame a little bit, but that's probably not the right way to say it. But I think it also gives insight to each board member and their own thinking and why they voted that way, which is exactly what you just communicated, Mitch, that you're going to have times where a lot of board members, they won't vote for it because and they won't vote for an increase. They won't vote for a pause or a decrease, but we'll get to see why and what their theory is and what their feedback is on the economy and how it's tracking. We don't really get a lot of that right now. We get the minutes from the RBA decision, which is mainly given in Governor Lowe's tone. And that's why obviously the blame game's all coming at him right now. So it'd be really interesting, to be at that press conference and ask them each their own opinion, what they voted for, why, what are the things that they're looking at, feedback. And that's probably more general data points that we can rely on. So I reckon it's a really good thing. It's a shame that they're doing it now rather than obviously, looking at doing it 12 or 18 months ago. But outside of that, I think it, as you said, it's just following the same tune as a lot of central banks around the world. So it makes sense that we're heading that way.
Yeah, definitely. definitely. And I think, anything to sort of improve transparency and improve the lines of communication, just to avoid any sort of, like the blunder we saw in 2020 where, the RBA sort of communicated that there wouldn't be any interest rate increases until 2024. It's not exactly what he said, but that was how it was construed by most people.
I'm laughing because now that they've gone through the review, the proposals have come out. I listen to other podcasts as well. I'm probably the number one subscriber for Expat Chat though. But with that in mind, the recording of him saying that has been doing the rounds on a lot of other different podcast shows for the last week is just astronomical. Everyone's had the recording of him saying, "Listen, we're probably not going to live, the cash fame until 2024." Real foot and mouth disease, that one, and a bit of a gaffe. But I think it's all for the positive. I want to steer us over to the next topic, which we'll try and do a bit of a quick one because we're moving through it. This one, changing gears again, and it's come up with a client recently who's been given the option, and this is mainly for our listeners that are in the United States, the benefits / trade-offs of an E3 visa, which many Australians and Aussies will know, versus going down the pathway of getting a green card and then eventually a US citizenship or a passport, I guess you could say. There's some quick trade-offs. I'm going to start with what I love about the E3 visa is it's a really clean cutoff when you leave the US, in terms of your obligations for a US tax return. You're essentially doing a final tax return with the US and that's it. And there's some really attractive benefits with that, especially if you own some shares or you're receiving restricted stock units, RSUs or options from the US employer. That can be quite attractive from a tax minimization aspect. And when we're on an E3, you've got your similar reporting requirements as if you were a green card or a citizen. But I just really like the fact for a lot of my clients that they won't have to continue reporting anything to the IRS because the IRS wants to know everything. What about you, Mitch?
Yeah, you make some really good points there. I think what we sort of, how we put it to a lot of clients or prospects that we speak to is you're less sticky to the IRS at the time that, when it does come time to, leave the US, is probably the best way to put it. But yeah, if you look at, a green card, it affords you the same, rights and responsibilities as a US citizen. You've got it for 10 years. So, you're not having to renew it as often like you otherwise would have to with a temporary visa, such
That's
as
true. Very true.
the E3.
Yep.
But yeah, just, in terms of the green card, there's a formal process. So when you do come back, should you come back to Australia, you want to return that green card. There's a formal process that you have to follow to, submit that return that you no longer want to be a permanent resident for tax purposes.
I think a lot of people
just on that too.
Oh yeah, Mitch,
do that.
I was going to say I'll let you go. I think you're about to say exactly what I was about to say. You go.
Yeah. So it's a particular form. I think it's form I-407. So you need to submit this form to formally cut ties and return that green card. I've unfortunately seen some cases where long-term permanent residents in the US have come back and they haven't returned that green card. So technically they've, for the last however many years, they've been required to still report their worldwide income to the IRS and still keep up with those, all the information reporting data that you need to FBARs, Form 8938 to the foreign assets, all that sort of stuff as well.
Yeah, and I think that's a common one where when we get a green card and we come back to Australia, a lot of it, the green card technically does expire, but your obligations, even though that green card has expired, don't stop. You're still meant to keep doing your reporting requirements. You're meant to actually formally sort of give up the green card. There's a process as Mitch just described, but a lot of people just let it expire and go, oh, cool, I don't have any other responsibilities with the IRS. I'm done with the US. But I'm sure if you left it 5 or 10 years, you'd have some funny letters start coming back to you from the IRS, or maybe when you head back over there, IRS wants to have a little chat about overdue taxes and fines, those sort of things. So it is important to acknowledge that just by letting the green card expire doesn't mean that's your former cessation or cessation with the IRS in the US. I think that's a really important. I think long-term benefits when you've been either on an E3 or a green card, if you've got your minimum 40 quarters or 10 years in the US, you should be entitled to Social Security when you head into your 60s. And that's probably the best thing that has come out of our double taxation agreement. Social Security, US Social Security, if you're living in Australia, is not taxable by the ATO at all. That is clear, and that's clearly written in our treaty. It is still taxed on the US side, and you can actually set the sort of withholding tax rate depending on any other US sourced income. But that's a really good one based on the Social Security tax that you paid through the ordinary tax system. If you've done 10 years, you're going to get that benefit. And a lot of expats forget that. They forget once they've been there on an E3 for 15 years, they'll come back and they'll actually forget about those entitlements. But you can still claim on those entitlements, and they're often not tested with assets and income back in Australia. So that's a really important one. I'll stop harping on, but those are some of the main trade-offs that I would say.
Yeah, definitely. I think that's a good sort of summary, James. E3 or temporary visa versus green card. I think we might wrap it up there.
Yep.
Great chatting with you today, and we'll see everyone on the next episode of Expat Chat.
Sounds good. Thanks for tuning in, guys. See you on the next episode.
Thanks, guys.